Good day, ladies and gentlemen. This is Barry Norman on behalf of investing.com, and welcome to our webinar about CFDs, contract for difference, one of the fastest growing investment vehicles in the marketplace. You can trade CFDs for stocks, for commodities. Virtually anything can be traded in a CFD. Now, CFDs are regulated and they are growing around the globe. Most countries or most regulators have approved CFDs and allow them to be traded within their country. It is growing astronomically, only because it is the easiest way to trade in the markets. Basically, trading CFDs, trading stocks or trading a stock with a CFD are virtually the same, except ownership and the amount that it costs you to get into the markets. Now, CFDs have been in the news a lot lately as regulators have reduced leverage to reduce the risk, because a lot of new traders come in and try to trade and make a fortune right away using ridiculous amounts of 400-to-1 leverage, and they lose their money right away because they don't have any idea what they're doing. They just simply decide, look at that, I could buy $40,000 worth of Apple for my $1,000 investment. And they don't understand the swings of the marketplace. They don't understand where to put their stop losses, where to put their take profits. They don't even really understand what the risks are. And so it is very difficult with huge leverage to protect new traders or traders that don't use money management skills. But otherwise, CFDs are no different than trading any other financial instrument. You have to know what you're doing, but they don't change. If you're trading a CFD for gold, or you're trading a gold future, or you're buying physical gold, it's virtually the same thing. The biggest difference is with a CFD, you do not own the underlying asset. Now, CFD stands for contract for difference. This is a type of financial instrument that allows you to benefit from fluctuations in stock, commodities, and index prices without really purchasing them. You can profit from the difference between the opening price and the closing price of certain positions open on a certain CFD instrument. It is important to us to emphasize that you don't own the asset. Okay, and most traders offer all types of CFDs. Now, CFDs are a leverage derivative financial product. Face it, that's what they are. But whether you're trading Forex or if you're trading stocks and you want to buy 10,000 shares of a stock trading at $100 a share, you need to come up with $100,000 in cash. And to be honest, you buy that share and it makes a significant move. It moves $1. You made, what, $1,000. But if you only had $5,000 in your account, you could only buy 50 shares, and that stock moved $1, you only made 50 bucks. Didn't even cover your costs. So what CFD does, it leverages you up so that you can trade more quantity. Still the same movement, same the direction. The biggest difference is if you bought 1,000 shares of XYZ company, you would actually own them. You could sit on them as long as you want, but you'd have to dish all that money out of your pocket. Okay. Now, you could then eventually sell them when they moved up at a later time. But do you have the $100,000 to dish out of your pocket? That's the question. 1,000 shares at a stock trading at $100, that's $100,000. If it moves $1, you would make $1,000. That's it. Now, when you trade CFDs, you take a position on the change in the value of the underlying asset. Now, CFDs function and move at the same price or in relationship to the actual asset. It's a few pips difference, but it moves in the direct relationship. It's pre-programmed. It doesn't shift around. If Apple goes up 10 points, so will your CFD, okay, from where you had entered the market. You are essentially betting on whether the value of the underlying asset is going to rise or fall in the future compared to what it was when the contract was taken out. All CFD companies let you trade both long and short positions. You can sell an asset now to buy back later, or you can buy now to sell at a higher price. Going long means buying a CFD in the expectation that the underlying asset will increase in value. Going short means selling a CFD with the expectation that the underlying asset will decrease in value. In both cases, when you close the contract, you hope to gain the difference between the closing value and the opening value, whichever way you've traded it. Now, for example, you might buy a CFD, go long, saying it's going to go up over for company X's shares. If the price of company X's shares rises and you close out your CFD, the seller of the CFD, the counterparty, will pay you the difference between the current price of the shares and the price when you took out the contract. However, if the price of company X's shares fall, then you would have to pay the difference. Okay. Simple market and movement. Okay. Nothing complicated. It's very easy to understand. Now, this could be many times the amount of money you originally put in because of leveraging. Leveraging is the thing you need to understand. CFDs do not have an expiry date like options or future contracts. And that's one of the reasons CFDs are much better than options or futures contracts, because a futures contract that expires or an option that expires on a certain date at a certain time is moving against you. Even if the asset is expected to move up, there is a certain day and time that option will be closed. So you're always fighting a time element. With CFDs, you can keep the CFD open as long as you want. Now, CFDs are designed as a short-term investment, but if you need to keep them open for a longer period for the market to move in your favor, you can. A CFD can only be closed by making a second reverse trade. So in other words, if you bought Google and you now want to close your position, you now sell Google. So if you bought 10,000 shares of Google, you now sell 10,000 shares. So it's two transactions, but you can do this at your convenience, at your decision. There is nobody forcing you to close your position. Now, finally, it cannot be stressed enough that trading in the financial markets carries a high level of risk and may not be suitable for everyone. Before deciding to trade foreign exchange, CFDs, stock market, you should always carefully consider your investment objectives, your level of experience, and your risk appetite. I cannot reiterate how many times that it is important to understand at all times the risk element in which you are taking. Not that you've got $1,000 in your account and that's all of your risk. It is not so. You have to, most traders, especially beginning traders, or most traders that are starting to use leverage, get, number one, addicted to leverage because they think, wow, I can crank all this up. So for my $1,000, I can buy 400,000 euros. Well, remember, you have the chance of losing as much as you have the chance of gaining. Always use risk management skills to decide how much leverage you want and how much you're willing to risk. This is more important than figuring out how much profit you're going to make. If you constantly limit your risk, your profitable trades will come and you will have less losses to cover. Now remember, you could sustain a loss of some or all of your initial investment, which means that you should not invest money that you cannot afford to lose. If you have any doubts, we recommend that you seek advice from an independent financial advisor. Do not jump into the markets because somebody simply told you or suggested you what to do. Okay, guys, somebody just wrote in a question and I'll read the question. Kindly suggest a strategy for position trader. Okay, we're not here discussing positions. Okay, this is a class with several hundred people in it that are here to learn about CFDs. This is our class. Now, if you would like private consultation, you can arrange that through my website, and I charge several $100s an hour, and you can be paid for your personal consultation. Otherwise, the class is set just like a lecture in a university. Your professor gets up, and if he's a lecture on biology, he's going to lecture you on biology on the subject and the matter he has set up in his lecture. So I thank you, but please don't think I'm ignoring you. I just don't have the time to do the class and answer your personal questions. Now, let's look at your choices. Now, don't be intimidated or confused by terminology. That seems to have nothing to do with the assets themselves. Okay. There's spot, there's CFD, there's futures trading, there's binary option trading, there's all of this crazy stuff out there. Okay. The fact is, almost all of it is just simply tied to the asset underneath of it. So let's talk about gold. Now, you could go physically down the street to a coin dealer and buy some gold coins and put that gold in your pocket, in your vault, under your bed, and that's ownership. And that's like the spot market. That, when he sells it to you, that's the price on the current market to take physical delivery. Okay. If the gold is trading in the physical spot market at $12.50, the futures market would also be selling the current month's gold at $12.50. But in the futures market, you could buy gold for June, you could buy gold for delivery in July. And the price for that gold is relatively tied to the spot price, but there could be things that would affect June or July gold. Like for instance, if there's a Federal Reserve meeting that we're expecting a rate increase in June, then we would correspondingly think gold would be dropping. So gold might be less expensive if you're buying the June contract. Okay. Now, okay. Somebody else writing a question. I do not recommend any brokers whatsoever. Okay. Somebody wrote, sir, what I have to look for before choosing a good CFD broker. Any suggestions? First, stick with the biggest brokers in the world. I don't know what country you're in. I don't know what you're all about. I don't know who's regulated in your country. But stay with the big name brokers, not the guy who's advertising all over the because CFDs, and we're going to get to that in a minute, CFDs are not an exchange traded item. It's an item traded between you and your broker. And that is very important because the reputation, dependability, and reliability of that broker and his regulation. And the first thing you should do is anytime you're looking at a broker, find out who they're regulated by. On the bottom of their homepage, it's going to tell you the actual name of their company because they might be advertising Billy Bob's brokerage, but Billy Bob's brokerage is owned by somebody. You need to check out who owns it. It's by law on the bottom of their page as well as their license number. Okay. Make sure, number one, that they're regulated. Find out their license number. Then find out if they're regulated in your country. Then find out how big and how established they are. Because if you look at a lot of them, they've only been around for 6 months or a year because it's a big new investment. So do nothing different than if you're going to buy a car. Okay. You're going to buy a car from a manufacturer that you know. You're not going to buy some little local manufacturer who you don't know about, don't know if the chassis is going to fall out the bottom, or you're going to buy a used car. You're going to go to somebody with a reputation, a warranty, and that is above board. That's all I can tell you. Otherwise, they're pretty much the same, and you have to find who you like dealing with. Now, let's go back to gold. So you could buy spot gold, which is physical delivery. You could buy gold in the futures market, and then it depends on what month. But remember, when you buy in the futures market, your time is ticking down against you. There is a date and a time that futures contract will expire. Okay? Even though you're way in the money, if you didn't close it out and take your profits, it will expire. And as you get closer and closer to that expiry date, even though it's moved more in your favor, it has less value. So you have to be very, very careful in the futures market. Futures market also requires a lot higher investment, a lot higher margin. Then you have CFD. CFD is like buying gold in the spot market, and it's still based on the underlying asset. In the gold futures market, you never take physical delivery. In the gold options market, you never. Only in the spot market do you take physical delivery. Now, do you want to be responsible for picking it up? Do you want to be responsible for security delivery to your home? Do you want to be responsible for storing it? Do you want to have insurance on it? Or would you rather have it on a piece of paper between you and your broker or you and exchange that you don't have to do all of those other things? So a CFD is simply a contract for only the difference in the value. That's it, of the gold. You just don't own the gold, but you haven't laid out the money. In most cases, well, today a lot of the regulators have cut back or are discussing cutting back leverage. Okay. That means in a CFD contract for gold, you have $1,000 in your account, you might be able to buy $50,000 worth of gold. Well, gold at $1,200 an ounce, that's a lot of ounces of gold. Do you want to go get them? Or in most cases, just like stocks, I own lots of stocks. I don't have the certificates. I mean, my pension fund, my retirement fund's been buying them for years, but my broker holds them. So do I actually care that I own them? The only time that you care if you own it is if you need to go borrow money. Because one thing about it is if you buy, they become an asset that you own. So if you need to go put them as collateral against the loan, you need to go put it up at the bank. Or if you list them on you have to do a financial statement, you can list them an asset because you physically own them. But remember, when you physically own something, in order to turn it into cash, it has to be liquid. You have to be able to go sell it somewhere, and you have to be able to cover the cost of selling it. And whenever you want to sell something, the guy on the other side wants to make profit. And so he's not going to offer you the price he can buy it anytime he wants in the marketplace. He's going to offer you a lower price. So in most cases, we don't want to have a physical asset. Okay, now the debate about CFDs and Forex and futures is really a waste of time and not worth worrying about. Spot and CFDs are essentially the same thing at this level. They change if you're investing millions of dollars. There's slight differences in spreads. There's slight difference in underlying costs and commissions. There's sometimes a slight difference in the tax ramification. Please don't ask me what the tax ramifications are. That requires you and a tax accountant or a tax lawyer. Okay. Some countries have tax because CFDs are much different, but like in England or the UK, in most cases, CFD profits are not taxable. Okay. So you have to find out, and it's on a personal level. Okay. Now, futures are a little different than because they can be less liquid and their price is influenced more by market forecasts. The important thing is to check that the instruments okay. When it comes to Forex versus futures versus CFDs, you will almost certainly find that the major stock Forex pairs are the cheapest to trade. Gold, silver, oil, and the major commodities are always the cheapest to trade because in CFDs they're no much different than trading in the Forex market or in the options market. There is a slight difference in trading in the stock market because in a CFD there is a spread. The difference between the buy price, and the sell cost. But of course your broker has to make profit, and the difference between the spread is what your broker is covering the cost of the transaction and some of your broker's profit because he's not betting on in a legitimate regulated brokerage. He's not betting against you. He's not taking the opposite side. He's not making money if you lose. He's making money by transactions. And he's also financing your transaction because even though you're buying $1,000, you're putting up margin of $1,000 for $50,000 worth of gold, somebody has to finance that amount of money. And that is covered with your spread. And sometimes there are, especially if you're going to hold on to CFD for a long period of time, there might be sometimes an interest charge. It is nominal. In fact, in most cases, it's not discussed, but you can find it from your broker. It's published, but it is so small that nobody pays any attention to it. Now, unfortunately, the costs don't end there. Forex brokers also charge extra to hold most of these contracts overnight. If you're trading Forex, but very often do not advertise their charges explicitly on their website. If so, contact them and they should be able to tell you and be very happy, and their rates currently are. They are all competitive. It's not something that one broker will have a different than another because it's just simple interest rates and it's a small amount. But make the calculation again. You will have a lot. You will have all, you need to know at any given time all of your costs. But you'll find the cost in CFDs is relatively small. And it's in the spread. The spreads are competitive between brokers. Yes, if you're going to trade some exotics, okay, And nobody should really be trading exotics. If you're trading exotics, then the spreads get higher and higher. But when you're trading the major assets, the major stocks, the spreads are comparable. And it's the difference between the buy cost and the sell cost. If you don't understand the spread, it's important that you do. But just think of it, if you're going on vacation and you're going from London to Tokyo, in London, you're at home. You have pounds. You need to go to the bank and get Japanese yen. Now, there's a price that the Japanese yen is selling for that is an institutional price or is the primary price. But the bank's not going to sell it to you or buy it from you at that rate. They're going to sell it to you for a couple points higher or buy it from you from a couple points lower, whichever you're doing, because this covers their processing costs. This covers their commissions. It covers all the costs in moving this currency and all the bookwork. But the spreads are relatively small. So when you go to the bank and you go there with, say US dollar to euro, you go there and euro's trading at 129 to the dollar, and they say, okay, well, you want dollars, we'll give you 128.50. You get 128.50 for every 129 euros. It's an insignificant amount. But so never trade what you don't understand. The difference between where a trade is entered and exited in a contract for difference is where you make the profit. A CFD is a tradable instrument that mirrors the movement of the asset underlying it. It allows you for profits and losses to be realized when the underlying asset moves in relationship to the position taken. But the actual underlying asset is never owned. So that is the fine difference. Okay? Essentially, it is a contract between you and the broker. Trading CFDs have several major advantages, and these have increased in popularity over the last several years. CFDs are undoubtedly one of the most widely traded financial instruments in the UK as well as the European markets, growing in popularity as traders around the globe become more familiar with what they are and how they can utilize them as a broader part of a broader trading portfolio. Traded predominantly off exchange. That means there is no global exchange for CFDs. There is no, it's not like stock market where they're going through the New York Stock Exchange or the FTSE. But most assets are traded off of exchange. Currencies, there's no exchange for. Okay, no matter how you're trading currencies. Okay, CFDs provide completely built-in leverage for traders looking to ramp up their earnings and utilize a considerably more flexible tool for investing on the power and weakness of long-term assets and indices. Because a CFD packages it all together. It's less, the understanding and the knowledge you need is the same. It's the complexity of actually placing the sale. A CFD, you just go under your broker instead of clicking under, options or futures or gold, you click under CFDs and they're all listed out there, and you have the same gold CFD, the same euro CFD, the same Apple CFD, except, and they've already got the leverage and the margin built in. You click on the button you want, you pick on the direction, and then you do the rest as you would do for any other trade. You can put in your stop loss, put in your take profit points. Everything is right there. Okay. Now, CFDs provide much higher leverage than traditional trading. Standard leverage in the markets begin as low as 2% margin requirement, depending on the underlying asset or shares, for example. Margin requirements may go up to 20%. Lower margin requirements mean less capital outlay for the trader and greater potential returns. However, increased leverage also magnifies your losses. But when you stop to think that a currency trades in small increments called a pip, and if the euro moves from 128.50 today to 128.60 today, that was a significant move. Okay. But if you only owed a couple euros, it made no dent in anything. So you have to be able to get in the market with a large enough coverage to make the profit on tiny little incremental moves. I mean, if gold moves 25 cents and is trading $1,250 and it moves 25 cents and you own 2 ounces of gold, you made 50 cents today. So you need to own enough to ramp up your earnings potential. And that's what CFDs do. Now, okay. So if you were to go long in 1,000 CFDs and your margin was 3%, so in other words, you'd have 10,000 shares of something and it was 5 pounds a pip, and you had a 3% margin, your investment would be $1,500. Okay. If you had a 5% margin, your investment would be $2,500. So the bigger the higher the margin, the higher your costs are. But it's still a small amount of money. While CFDs appear attractive, they also present some potential pitfalls. For one, having to pay the spread on entry and exits eliminate potential to profit from small moves. And this is what's very important. Okay. Remember, in any asset, you're going to have your costs. Okay. But especially in CFDs, if the CFD moves in your favor, but you're dealing with a spread of 8 points, it must have moved 8 points in your favor for you just to break even. So if it moved 12 points, you only really netted 4 points, which is a small amount. But it's a small, insignificant amount. But any asset you trade is going to have cost to it, depending on how they are attached to it. But in most cases, you're always paying a spread, or you're covering a commission cost, or you're covering, you're paying something. So you always have to calculate your costs in. So the spread will also decrease winning trades by a small amount. It will increase losses by a small amount. So while other types of trade expose traders to fees and more regulation, commissions, and higher capital requirements, the CFD market has its own way of trimming traders by the way of larger spreads. The fact is, no matter how you do it, there is cost involved in everything. And the costs actually come out relatively the same, okay, if you figure them all out. It's like you go to buy a new car, and one car dealer says, I'll sell it to you for $10,500, but then the other guy down the street says, I'll sell it to you for $10,200. But you find out he's not giving you the 2-year extended warranty. There's always something in there because they all have their bottom costs, and everybody's got to make profit. So it really washes out to the same thing. Now, the most important is that the CFD is regulated, but it is not highly regulated, although that's changed radically in the last 6 months. The credibility of the broker is based on reputation, lifespan, and financial position. There are many fantastic CFD brokers, but it is important, as with any trading decision, is to investigate whom you trade and which broker best fulfills your trading needs. Now, getting to grips on the nuances. Every asset has its pros and cons and different trading instruments, but you have to understand them all. Okay, you can't just blindly go into a marketplace and say, I'm going to do this. Spend the time to learn all of them. Okay. But they basically have the same characteristics, only slight variations. Okay. Now, disadvantages of other industries versus CFD. Less liquidity than brokers. CFD. The nice thing is, since CFDs are broker offer product, you can open them and close them on a dime. So you don't have to worry about a fast-moving market and slippage. You can close instantly, so they're a lot more liquid. This means your order gets filled per your request when you request it, ensuring you preserve your profits and pay out your anticipation, and you can close right on the money. Expiration date. The expiry date attached to futures serves as built-in price decay, whereby the value of future contracts is gradually eroded, all things being equal, the closer you get towards the expiry date. But beyond that, the defined end date eliminates the flexibility of the CFD. One of the CFD's greatest strengths by stipulating and compelling the bearer of this futures contract to act on his order on the date. Guys, listen. You're writing in all of these great big questions. Number one, most of them I'm not going to answer today, but I also can't read a paragraph and a half while I'm teaching the class. So unless you can make your question in a few words, it's not going to get read or answered because I can't sit here and stop the class to read this long book that you're writing me. Okay. Now, most of your questions will be answered in the class if you just follow along. The expiration attached, so we talked about expiration, whereas CFDs can be allowed to run almost indefinitely until your money runs out, as long as you can cover the margin. Futures have a set in stone expiry date that cannot be altered or multiplied. Now, future contracts are often prohibitively expensive for small traders to invest in because of the rigid size of contracts. Like, in a gold contract in a futures market is 100 ounces of gold. That's it. Well, so if gold's trading at $1,250 an ounce, the only thing you can get into is a $125,000 contract. If you're trading in oil, that's 52,000 or 52,000 gallons or 1,000 barrels of oil. Okay. They have very rigid rules. While one CFD is usually equal to one share, that definitely isn't the case in futures. And traders will often be required to fund a hefty amount of capital upfront to acquire an interest in the markets. For this reason, CFDs are more flexible as they allow traders to take positions on the fly, whereas future investments, by the sheer scale, must be much more defined and much more well-reasoned. And for traders with modest amounts of capital to play with, it really does make sense to keep with CFDs over time. Now, there are other things to consider when choosing CFDs or futures. They're both leverage your money, which in practice means that you are charged interest by your broker. However, while with CFDs, the interest is charged only on a daily basis, with futures, the charge is priced into the asset. As stated, the competition for your business should ensure that the rate charged is reasonable, but this is something you should check at all times. You have to check one time, it doesn't change. As CFDs are typically a trading vehicle, you don't buy them to hold for a long time. You're not going to CFD because you think Apple is going to go up in a year and a half from now. You're buying Apple for a short-term basis with a CFD. Otherwise, you should be buying the stock. Okay. The interest is usually not enough to be a problem, but they do give you a choice to hold them a little longer if you need the price to swing in your way. And this is the nicest thing, is you can sit on them as long as you can cover the swing in the marketplace until they move into a profitable position and then close them. Okay. Now, many brokers offer to clients various trading platforms for manuals as well as automated trading. Providing different features and tools, traders can always find platforms which are convenient to work with. But my advice is to find a demo platform and try this in demo. Okay. Leverage offered by brokers allows you to open a position larger than what your actual capital is. Okay. CFDs, remember, and I'll keep emphasizing this, are a leverage product. This means you gain a much larger market exposure for a relatively small deposit, meaning your return on your investment is significantly larger than other forms of trading. So let's say you want to purchase 10,000 shares of Barclay, and its shares are trading at 28 pence, which means that the total investment for you to actually buy those shares would be £28,000, not including commission or other fees your brokers would charge you for the transaction. Now, with CFD trading, however, you would need a small percentage of the total trade to value and open the position. In most cases, you can get in stocks a 10-to-1 leverage. So you would only need 2,800 pounds to open up that same trade. Now, if Barclays rises by 10% to 308 pence, the valuation would now be 30,800 pounds. So with an initial deposit of 2,800 pounds, the CFD has just made you a profit of 2,800 pounds or 100% on your investment. compared to a 10% return if you had physically bought the shares. But the risk is still the same, because if they had moved against you, the risk would have been still the same. But if you only had 3,000 pounds in your account, you could have never made the first trade, but you could have made the CFD trade, and then you would have gotten back 100% on your cash or your capital outlay. The important thing to remember about leverage, however, is that while it magnifies your points, your losses are also magnified. So it's important that if it moves against you, manage your risk. Now, most CFD instruments are traded on floating spreads, which means that the difference are affected by the liquidity in the market. Now, CFDs are available on a huge range of different assets, including global indices, stocks, sectors, currencies, commodities. Unlike futures contracts, CFDs have no fixed expiry or contract size. Trades are conducted on a leveraged basis. While the trade opens, your CFD account will be credited or debited to reflect daily financing costs and dividend adjustments, if any, are issued during that period. So you can go long or short. If you go long, you are entitled to dividends and pay daily interest on the finance. If you go short, the reverse is applicable. CFDs reflect the price movement and pricing of the underlying asset in which they are based. CFDs provide access to the movement in the asset by putting down a small amount of the total market exposure. There is no restriction on entry and exit prices for a CFD. There is no time limit to exchange the price difference in the asset, nor is there any restriction on buying first and selling first. No actual shares are physically bought and sold, and you never have ownership of the underlying asset. A CFD can only be closed by making a second reverse trade of your original long or short position. Commission is paid on each side of a CFD trade, basically as a spread. Cash flows on trades are calculated each day. CFDs are not standardized products, and every broker has slightly different or their own terms and conditions. Now, because the broker isn't the market maker, most of the big brokers are using the same market maker, so their terms are all the same. But you should always look and understand exactly what the CFD is that you're getting involved in. So the biggest question you should be asking yourself is, how much can you afford to lose? The risk and complexity of CFD means that they are unlikely to meet the investment needs and objectives of every retail investor. If you trade CFDs, you are putting potentially very high amounts of your own money at stake. Here are some risks in CFD trades. Investment risk. This is that the risk of that investment market moves against you. Counterparty risk. This is the risk that the CFD provider or another counterparty to the trade fails to fulfill their obligation. Trading CFD exposes you not only to the CFD risk of the CFD provider failing to act as promised, but you could also lose money if the company the provider deals with or other clients fail to meet their obligation. This goes back to our discussion earlier about a regulated, reputable, large broker. This all goes away. Client money at risk. This is a risk of losing some or all of your money held by the CFD provider. Remember, your risk can be larger than your down payment or your margin. Liquidity gapping and execution risk. Market conditions and mechanics of trading might mean you cannot make trades when you would like to. This rarely happens in a CFD. It happens more in the futures market or in the currency market when markets are cascading. Because this is a broker-offered instrument, it is open and closed right by your broker when you click the button on your screen. So this is minimized in this type of trading. The success of CFD trading doesn't just depend on picking the right CFD to trade. When you trade CFDs, you're relying on the CFD provider to access and process your trades, make payments owed while your trades are open, credit any proceeds of profitable trades, pay you the money out of your CFD trading account when you ask for it. Okay? If the CFD provider gets some financial difficulties, they may fail to meet some or all of your obligations. Hence, regulation is important. Now that we've covered all the basics, let's look closer at how a CFD trading works. So I'm going to give you one more basic example. Let's say you believe the value of the FTSE 100 will increase against stronger than expected earnings or because from UK major companies. And most brokers will offer you the FTSE 100 called the UK 100. Okay. If you decide to go long and you buy the FTSE at 6,700, the UK 100 at 6,700, the trade size is one lot equal to 10 pounds per point. The position is valued at 67,000 pounds. Your only deposit required, which your margin is 500 pounds. The FTSE rallies 100 points to 6,800 and you close the trade. Your new position value is 68,000 pounds and the result is 1,000 pounds profit. Your return on investment is 207%. Now remember, your margin is not a fee. It's just a little bit of money that's put aside. It comes back to you. It's not, and a lot of brokers don't even actually remove it from your account. They just freeze within your account. Okay. It is not a cost. It is simply a deposit on that trade. It is not a premium that you're losing, so it's not factored in to your loss because it just comes back to you at the final calculation. Okay. Now, a losing trade is the exact opposite. You do the same exact trade, but the FTSE rallies 100 points to 6,800 and you close the trade. Your new position is at 68,000 pounds and you take a loss of 1,000 pounds and your negative return on investment is you lost 207% of your actual investment. But your out of pocket is the 1,000 pounds, not the 500 pounds plus 1,000. You have to come up with 500 more pounds out of your account. But it magnifies as well as it amplifies. Okay, a loss is magnified, a profit is amplified, same side. Okay, so it's important that you understand that. Now, when trading CFDs, you'll notice that there are two available prices. One is the sell and the other is the bid price. One is if you're buying and the other is if you're selling. The spread is essentially the difference in the price between the two figures. So if your buy price is at 65.05.7 and your sell price is 65.04.3, your spread is what? 13 points. If you want to buy that stock and it's selling at the moment at 65.000, you're still paying 65.057. That's the spread. You're paying a little bit more than what it's worth because that's where your broker goes to make his profit. When it goes up in profit and it goes up and you have to then sell it, you would have to sell it at the spread at that point at the sell price. So there's a spread covered on both sides, or the 13 points is what your net cost would be. So you have to remember that when trading CFDs. So they're not that complicated. The only problem I will warn you about, and I've done that over and over, is leverage up your equity or your margin account, your account. I mean, Warren Buffett made a quote just recently about leverage, and he said the problem is you can make huge profits and huge losses, but once you make a profit using leverage, you have a problem ramping down your leverage, and it becomes addictive. And that's what happens. You try 50 to 1 or 100 to 1, you have a successful trade, and you pocketed a $1,500 or 1,500 pound profit. Okay, your next trade, you don't think about going back down to 10 to 1 leverage. You've got yourself addicted to this high leverage. This is not a good thing. Remember, always looking at your risk is more important than looking at your profit. Okay, making sure you can afford the risk and stay in the market because you don't make profit on every single trade. And what happens is when you make your loss so significantly large that you wipe out most of your account, or you can't make enough successful trades to counter your loss. So loss is always important. When you want to get rich overnight, you're going to find you're going to get lost overnight. So always be very careful. Always ask your broker to explain your exposure and understand this concept. And this will allow you to stay in the markets long enough to get your successful trades in and also master the market. Because I've been trading for 40 years, and believe me, if I was that rich trading in the markets, I wouldn't be here teaching. Okay, I'm successful, small amounts, but I have as many losses as the average good trader does. And we all get sucked in because we're all too sure about a trade. And then what happens, I spend the next 3 months trying to make small trades to cover the loss I had. This is a bad thing. It's a bad thing for me. It's hard to do. But when you have a small account and you're new, it's too easy to get sucked in. So remember that at all times. But otherwise, CFDs are a great way to trade. 90% of my trades are in CFDs today. I mean, I started out for many years trading futures and agricultural markets, and now I've shifted completely to CFDs because I love the flexibility and the basics of a CFD trade. So thank you very much for joining us today. I hope you have the nice rest of the weekend. And we have our class in Japanese candlesticks tomorrow. And so set up for that. And we have a couple other classes coming up this week. We have a lot of classes towards the end of the month. So thank you very much. But give CFDs a try. Go find a good broker, a reliable big broker. Check their licensing. You do your checking. Remember, just like buying a used car, take it to a mechanic, get it certified, understand, kick the tires, drive it, then make your decision, and then trade in a demo account. Try this in demo for a while. Then when you think you've got it down pat, maybe risk a small amount of money. Thank you very, very much, and have a great weekend. Good night now.